Welcome to the deep dive. Today, we're looking at something, well, pretty puzzling in the financial markets based on a whiteboard Q&A video from Rebel Capitalist.
Exactly. It focuses on this seemingly contradictory behavior between U.S. Treasury yields and the U.S. dollar.
Right, especially when you throw stock market volatility into the mix.
Yeah, I mean, typically when the stock market drops and, the VIX spikes,
Volatility index, yeah.
right, investors usually run for safety, right? They buy U.S. Treasuries, which pushes yields down.
And the dollar usually strengthens as a safe haven.
That's the standard script. But this video highlights something different happening recently around April 2025.
It seems we saw the opposite. Yields going up and the dollar actually weakening, even with shaky stocks.
Precisely. It feels backwards. And what's really useful is the video compares this to earlier periods, like the survey sickness back in early 2020, and even the global financial crisis, the GFC, in 2008.
So the big question we're trying to unpack for you today is this current market weirdness really unprecedented?
Or, if it's happened before, what can those times teach us about what's going on under the hood and maybe what could be coming next? That's kind of our mission for this deep dive.
Okay, let's get into the details then. What exactly did the video observe happening in April 2025? It mentions some really extreme volatility in the S&P 500.
Oh, yeah. Wild swings. The video describes these incredibly rapid price movements all through April.
And it linked that to specific news, something about a freeze and tariffs.
Yeah, it seemed like a major trigger. There was talk about a potential 90-day freeze, which apparently gave the market a bit of a boost initially.
Okay.
But then the focus shifted to tariffs, a possible flat 10% rate, except for China. The video even mentioned what it called the largest green candlestick ever on the S&P chart from that news.
Wow. A huge jump then.
Huge. But then, just as fast, it seemed to, reverse course. The video really emphasized that intraday chaos, down big, definitely uncertain. Now let's look at the dollar, the DXY.
The U.S. dollar index, right, measures it against other big currencies.
Exactly. So lower DXY means a weaker dollar. And during all this stock market mess, you'd expect the dollar to get stronger, right, as a safe haven.
Yeah, that's the usual move.
But the video points out it actually fell quite a bit, from around 104 down below 100.
Below 100, wow.
Yeah, closed below 100, apparently hovering near a support level. Very unusual, like you said, when stocks are bouncing around like that.
It really does fly in the face of the typical risk-off playbook. Okay, so what about treasuries? The video mentioned the TLT.
Right, the iShares 20-plus year Treasury bond ETF. It's a common proxy for long-term yields. TLT up, yields down. TLT down, yields up.
Got it. So how did TLT behave?
Well, initially it did what you'd expect. Stocks looked shaky, so TLT went up.
Mm-hmm.
The video mentions it hit maybe 94, suggesting yields were falling as people sought safety.
Okay, that part makes sense.
But then, a sharp reversal.
Huh.
TLT started falling hard, down into the mid-80s.
So yields started rising again, quickly.
Very quickly. The video highlighted a crazy intraday jump in the 10-year yield, something like 35 basis points in just a few hours. That's a massive move for the bond market.
Okay, let's just quickly recap this puzzle for everyone listening. April 2025, you've got a super volatile stock market, a weakening dollar, and rising treasury yields, all happening together.
That's the contradictory picture the video presents. And the core question is this totally new? Which brings us to the historical comparisons.
Starting with the survey sickness in early 2020.
Right, those, triggered by the pandemic hitting big stock market crash.
And the Fed stepped in fast, didn't they?
Oh, yeah. Emergency rate cuts, basically to zero, announced massive repo operations, short-term bank loans, and huge quantitative easing, QE, buying assets.
Okay, and the dollar back then, what did it do?
It was interesting. The video points out it actually weakened first. DXY dropped from about 98.5 down to 94.5, roughly.
Okay.
But then it reversed sharply and started climbing, went up past 103 eventually.
Huh. So a drop, then a rise. And treasuries, did they also show weird behavior?
They did. Similar pattern, actually. First, the classic flight to safety. KLT shot up from maybe 140 to 180 as yields plummeted.
Right, people buying bonds.
But then, just like we saw described for April 2025, yields suddenly spiked. TLT tanked, back under 140.
Why, did the video say?
It linked that spike in yields to something called the basis trade blowing up. Basically, leverage trades in the Treasury market went wrong, causing forced selling.
Okay, so the big takeaway from the 2020 comparison
Is that these seemingly bizarre, contradictory moves in stocks, the dollar, and Treasuries in April 2025. They're not entirely unprecedented. We saw echoes of it during the survey sickness.
Got it. And the video also looked at the 2008 global financial crisis.
Yeah, another period of, well, extreme stress. It mentioned the really sharp stock market decline, especially September to November 2008.
And the dollar during the GFC.
Similar pattern again. The video notes an initial dip in the DXY, maybe from 80 down to 76, followed by a big surge upwards. So, again, initial dollar weakness, then strength.
It's a recurring theme. And treasuries back in '08.
Also very volatile.
Yeah.
Big swings in yields reflected in the TLT price. The video specifically points to a big surge in TLT, so yields plummeting, which it attributes directly to the Fed starting QE back then.
So looking at both 2020 and 2008.
The video makes a strong case that these volatile, sometimes counterintuitive moves in the dollar and yields, they can happen during major crises.
Correct.
What we saw in April 2025 wasn't necessarily unique to periods of extreme market strain.
Okay, so if it's not unprecedented, what could be causing it? The video started talking about foreign selling of treasuries.
Right, foreign central banks, maybe FX reserve managers, that kind of thing.
And it used these hypothetical examples, foreigner Frank and foreigner Fred.
Yeah, just to illustrate the potential dynamic. So foreigner Frank represents someone, maybe in an entity holding U.S. treasuries, but without any dollar debts.
Okay, no dollar liabilities.
Exactly. And maybe Frank gets worried about, I don't know, tariffs or sanctions, something like that. He decides, I want out of treasuries. I want into, say, German bonds.
So he sells his U.S. treasuries.
Right. Selling treasuries increases supply, pushes the price down.
And yields up.
Correct. Then Frank takes the dollars he got from selling the treasuries and sells those dollars to buy euros.
Which would push the dollar down against the euro.
Exactly. So that one scenario, Frank selling treasuries to buy foreign bonds, neatly explains rising treasury yields and a falling dollar happening at the same time.
Okay, that makes sense for Frank. But then there was foreigner Fred. His situation was different.
Very different. Fred has dollar liabilities.
Yeah.
He owes money in U.S. dollars, probably borrowed through the euro-dollar system.
Right. Dollars held in banks outside the U.S.
And the video really emphasizes that a lot of this debt is short-term, needs to be rolled over frequently.
So Fred constantly needs dollars to pay interest or repay the loan principal.
He does. And those dollars, the video points out, were basically created when he borrowed them in the first place from a Eurodollar bank. Now, getting the dollars to make payments or roll the debt can get tricky, especially when markets are stressed.
How might he get them?
Well, ideally, maybe through his business, earning dollars. But the video suggests, what if his customers, like Frank, are using fewer dollars? That makes it harder.
Okay.
Another way is just rolling the debt over. Borrow new dollars to pay the old ones. But, and this is key, if global liquidity is tightening.
Meaning it's harder or more expensive to borrow.
Yeah. Banks might get nervous, less willing to lend, so rolling over debt becomes difficult or impossible.
So Fred's in a tight spot. What does he do?
Well, the video describes one possibility. Fred might be forced to sell other assets he owns, maybe assets denominated in Japanese yen, for example.
Sells yen to buy dollars.
Right, just to get the dollars he absolutely needs for his debt payments. Now, that action, selling yen buying dollars, would actually tend to push the dollar up, at least temporarily.
Okay, wait. So Frank selling treasuries pushes the dollar down, but Fred selling other assets to get dollars pushes the dollar up. That sounds contradictory.
It does, but it highlights the complexity.
Yeah.
And there's another twist with Fred. The video suggests, what if Fred, instead of just rolling over debt, actually manages to get enough dollars to pay the loan off completely?
He just extinguishes the debt.
Exactly. And here's the kicker. Remember, those dollars were created by the loan.
Yeah.
When the loan is repaid, those euro dollars essentially disappear. They vanish from the system.
Ah, so the supply of dollars outside the U.S. actually shrinks?
Precisely. Which then makes it harder for other people or companies who still have dollar debts to find the dollars they need.
Creating more demand for dollars later?
Potentially, yes. It could lead to more forced selling of non-dollar assets down the road, pushing the dollar stronger later. It's like a timing mismatch in the flows.
Wow, okay.
Yeah.
So you have forces pushing the dollar down initially maybe, but also forces that could push it up later because debt is being destroyed.
That seems to be the dynamic the video is exploring. And it connects this back to historical patterns, noting that often these weird periods end or reverse when the Federal Reserve intervenes.
Like the basis trade issues in 2020 required Fed action.
Right. The video mentioned a sort of bailout there. And QE during the GFC was a massive intervention.
And the video suggested the Fed might have room to act again now, or around April 2025.
Yeah, it pointed to the relatively low inflation numbers at the time, CPI, PPI, suggested the Fed had, quote, plenty of cover to cut rates or do more QE if needed without worrying too much about immediate inflation.
Okay, so pulling it all together, the main point from the video seems to be.
That this strange market behavior, volatile stocks, weak dollar, rising yields, isn't some completely new phenomenon. It's actually a pattern we've seen before during times of significant financial stress or crisis.
So to summarize the core insight for you listening, that unusual dance between treasury yields and the dollar when stocks are volatile, it might feel wrong, but it has happened before in major crises.
Yeah, and understanding it involves looking at things like, well, foreigners potentially selling treasuries, the whole complex world of dollar debt outside the U.S., the euro-dollar system, and, of course, the potential for the Fed to step in. These pieces are all connected.
Right. And maybe a final thought to leave you with. Just consider the sheer scale of all that global debt denominated in dollars, especially the short-term stuff. How might that act as an amplifier for these kinds of volatile swings when things get stressful?
And following on from that, what indicators should you keep an eye on? What might signal that the Fed is about to act or that these trends in the dollar and yields are about to shift again? Some things to definitely keep thinking about. Thanks for joining us on this deep dive.